Hi, I'm Peter Mora, and I'd like to have a quick chat to you about how we invest our clients' money. Now, it all depends on what stage of life you're in. If you're a pre-retiree or a retiree, we invest your money via the bucket strategy. Now, I'll just give you a quick overview of what the bucket strategy is. What it is, if we split your assets up, your pension and your super assets up into three different buckets. So we put 3 years income into bucket number one, we put 4 years income into bucket number two, and the rest of your assets go into bucket number three, which is the engine room of your portfolio. Now, the reason why we do this is because we've done scientific and historical research of the share market, and the biggest drop in the middle bucket, number two, was in 1972, and it dropped by 21% and took exactly 3 years to come back. So because we've got 3 years income in bucket number one, which is a very conservative bucket, and and it did happen again, like in 1972, the middle bucket dropped by 21%. You got 3 years income there that you don't have to touch bucket number two. And the third and final engine room of your portfolio is in the third bucket, which with that portfolio of shares dropped in 2000. The biggest drop so far was in 2008, and it dropped by 47% and took 5.8 years to come back. Now, we'll go back, because you got bucket number one, you got 3 years income, bucket two, you got 4 years income. So all up, you got 7 years income before you have to start looking at bucket number three. So in that approach, it'll help you sleep at night knowing that you have a strategy that if the share market did take another dive, that you would be okay. Now, you do hear the stories, horror stories, where some people in the GFC did retire in 2008 and they had to go back to work. The reason was because if they just went out and simply put their money into a balanced portfolio, in 2008, a balanced portfolio dropped by 30% and it took 5 years to come back. So if we use roundabout figures, if you sort of had $500,000 in a balanced portfolio, it dropped by 30%, it would now be worth $350,000. You want $40,000 a year income, times 5 is $200,000. So at the end of 5 years, you've now got $150,000. A bit scary, right? But if you set your money up in the bucket system, you wouldn't be your portfolio would be much better off doing that. Now that's for pre-retirees and retirees. And if you're say a 35 or 45-year-old, your asset allocation would be completely different. We'd have to work out exactly where you are, what sort of assets you have, and where you want to go to. We'd sit down and work out what sort of risk you want to take, and then we'd say, look, to hit your goals, you need to take on this much risk. Do you want to do it? Yes or no? And then if you're happy to do that, we'd take the next step. So it's all about asset allocation, where you want to go, and what you want to get out of it. Now, just going back to rehash the bucket strategy, I think the bucket strategy is a fantastic idea. When I get to retirement, I'm going to use that for my own retirement. I now currently use that in my firm with my current pre-retirees and retirees, and they absolutely love it. They all come back and tell me that they can sleep at night and not be too concerned about the share market. Now, everyone's different. This approach mightn't suit you. It suits 90% of my clients, but you might want to do something different, and we're open to that as well. But thanks for your time. We'll speak soon.